I could have had twice the wealth I have today if I hadn't made one catastrophic mistake in the 1980s. One decision, one moment of weakness, and it cost me hundreds of millions of dollars. Not because I was unlucky, not because the market crashed, but because I violated my own rules and let emotion override logic. I'm Peter Lynch, and I turned $18 million into $14 billion at Fidelity Magellan. But the mistakes I made along the way taught me more than any success ever did. Today, I'm going to share the mistakes you must avoid if you want to build wealth, find happiness, and live a life worth living. These aren't theories. These are lessons written in blood, sweat, and regret. Before we begin, subscribe now, like this video, and leave a comment. That simple action helps more people see this content, and it tells me that sharing these hard-earned lessons still matters. Now listen closely, because what I'm about to tell you could save you decades of pain and millions of dollars in losses. Mistake number 1: overspending your income. Let me start with the most fundamental mistake that destroys more lives than any other: spending more than you earn. This sounds so obvious that you might roll your eyes, but look around you. How many people do you know who are making good money but living paycheck to paycheck? How many are drowning in credit card debt? How many are one emergency away from financial catastrophe? I think about Mozart. Here was perhaps the greatest musical genius who ever lived. Talent that comes along once in a millennium. And what was his life like? He was bitterly unhappy, and he died young at 35. What did Mozart do to screw up his life so badly? Two things. First, he overspent his income chronically, relentlessly. He couldn't help himself. He earned good money for a musician of his time, but he spent more. Always more. The result? Constant anxiety about money, constantly borrowing, constantly dodging creditors, constantly stressed. All that genius, all that talent, wasted on financial anxiety that was completely self-inflicted. You can be the most talented person in the world, but if you overspend your income, you will be miserable. During my years at Fidelity, I watched countless people make this mistake. Executives earning $500,000 a year who were stressed about money because they were spending $600,000. Traders making millions who were broke because their lifestyle consumed everything plus more. It didn't matter how much they earned, they always found a way to spend more. The formula for financial misery is simple. Earn X, spend X, plus 10%. Do that consistently, and I guarantee you a life of anxiety, stress, and unhappiness. It doesn't matter if X is $30,000 or $3 million. The math works the same way. Here's what I learned early. Warren Buffett and I, when we had tiny little bits of money, we always underspent our incomes. Always. We invested the difference. And if you live long enough doing that, you end up wealthy. It's not complicated, it's not sexy, it's just math and discipline. But people don't want to hear this. They want the secret to getting rich quick. They want the hot stock tip. They want the shortcut. There is no shortcut. The path to wealth is simple. Earn more than you spend, invest the difference in quality assets, and repeat for decades. That's it. That's the whole secret. Mistake number 2: living with jealousy and resentment. The second thing Mozart did that guaranteed his misery was he was full of jealousies and resentments. He couldn't stand that other composers got commissions he wanted. He resented patrons who didn't appreciate his genius. He was bitter about his circumstances. That jealousy and resentment poisoned his soul and made him miserable despite his extraordinary talent. I see this mistake everywhere, especially in the investment world. People comparing their returns to others. Resenting when someone else's stock pick does better than theirs. Getting bitter when a colleague gets promoted. Feeling jealous when a friend buys a bigger house. Let me tell you something I learned. Jealousy and resentment are the only sins that give you no pleasure at all. Think about it. If you're greedy, at least you get to enjoy spending money. If you're a glutton, you get to enjoy eating. Even lust gives you some temporary pleasure. But jealousy? You just sit there stewing in your own bitterness while the person you're jealous of is off enjoying their life, completely unaware of your suffering. It's the dumbest possible way to spend your emotional energy. Yet people do it constantly. They poison their own happiness by constantly comparing themselves to others. Someone always has more money. Someone always has a better house. Someone always has a better car. If you play that game, you will never be happy. Never. I made it a point throughout my career not to compare myself to others. I didn't care if another fund manager had a better year than me. I didn't care if someone else found a stock before I did. I focused on doing my job well, following my process, and not letting envy cloud my judgment. That discipline saved me from countless bad decisions driven by the need to keep up with or outdo others. Mistake number 3. Pretending to know what you don't know. Here's a story that illustrates this perfectly. A young man comes to visit Mozart and says, "Mozart, I want to write symphonies." Mozart asks, "How old are you?" The man says, "I'm 23. Mozart replies, "You're too young to write symphonies." The young man protests, "But Mozart, you were writing symphonies when you were 10 years old." Mozart says, "Yes, but I wasn't asking other people how to do it." This story captures something profound. The young man wanted to skip the learning process. He wanted someone to tell him how to be a genius. But genius doesn't work that way. Mastery doesn't work that way. You can't shortcut the process of learning through doing, through failing, through figuring it out yourself. In investing, I see this mistake constantly. People want me to tell them which stocks to buy. They want the formula. They want the secret. But that's not how it works. The truth is, not everybody can learn everything. Some people are just better at certain things. And no matter how hard you try, there's always going to be someone who achieves more. My answer to that is, so what? Does any of us need to be the very top of the whole world? That's ridiculous. You don't need to be the best investor who ever lived. You just need to be good enough to meet your financial goals and live well. But here's what you absolutely must do. Know the limits of your knowledge. Know what you know and know what you don't know. And when you don't know something, admit it. Don't pretend. Don't fake it. Don't act like you understand something you don't. I spent my career at Fidelity studying companies, thousands of them. I visited factories. I talked to management. I read annual reports until my eyes bled. And even with all that work, there were plenty of companies I didn't understand well enough to invest in. And you know what I did with those companies? I passed. I moved on. I found something I did understand. The investors who get into trouble are the ones who pretend to understand things they don't. They buy complex financial instruments they can't explain. They invest in businesses they haven't researched. They follow tips from people who don't know any more than they do. And then they're shocked when it all blows up. Mistake number 4, trying to do things that are difficult instead of finding things that are easy. This is a mistake I made personally and learned from the hard way. When I started at Fidelity, I tried to be too clever. I looked for complicated investment theses. I tried to predict macro trends. I tried to find hidden value in obscure situations. And sometimes I was right, but often I was wrong. And even when I was right, it was hard work with mediocre returns. Then I changed my approach. I started looking for things that were easy. Companies with obvious competitive advantages. Businesses I could understand by walking through a mall. Products people loved and kept buying. Simple, boring, obvious opportunities that everyone could see, but most investors ignored because they weren't exciting enough. You know what happened? My returns improved dramatically. Not because I got smarter, but because I stopped trying to be smart and started trying to be simple. I found things that were easy to understand and easy to evaluate, and I bought them when they were reasonably priced. Think about my best investments. Dunkin' Donuts. People love coffee and donuts. Easy. Toys R Us. Parents buy toys for their kids. Easy. Home Depot. People fix their homes and need tools. Easy. None of these required genius-level analysis. They just required paying attention to what was working in the real world and having the discipline to invest in it. The mistake investors make is they think investing should be hard. They think if it's not complicated, it can't be valuable. So they ignore the obvious opportunities right in front of them and chase complex, exotic investments that usually don't work out. If you look at Berkshire Hathaway, Warren Buffett's company, think of its founding businesses: the Kemper, a doomed department store, a doomed New England textile company, a doomed trading stamp company. Out of that came one of the most valuable companies in the world. How? By recognizing the mistakes early and getting into better businesses. By finding things that were easy: insurance, candy, beverages, and avoiding things that were difficult. We weren't so good at doing things that were difficult. We were good at avoiding things that were difficult and finding things that were easy. Mistake number 5, making too many decisions. Here's something most people don't understand about successful investing. It's not about making a lot of decisions. It's about making a few good decisions and letting them work. If you actually figure out how many meaningful decisions were made in the history of Fidelity Magellan during my tenure, it wasn't very many per year. Remember, maybe a handful, maybe a dozen at most. The game is being there all the time and recognizing the rare opportunity when it comes, and recognizing that a normal human allotment is to not have very many great opportunities in a lifetime. But there's a whole industry of people, brokers, advisors, newsletter writers, who act as though they've got an endless supply of wonderful opportunities. They're constantly telling you to buy this, sell that, trade here, move there. Those people are the equivalent of the racetrack tout. They're selling action, not wisdom. They're not even respectable. My advice to you is avoid those people. They will cost you money. They will get you to overtrade. They will get you to make decisions when the best decision is to do nothing. You don't have to swing at every pitch. In baseball, you have to swing at good pitches or you strike out. But in investing, you can watch 1,000 pitches go by and wait for the perfect one. Nobody's going to call you out for being patient. Most investors destroy their returns through activity. They can't sit still. They feel like they need to do something. So they trade, they switch funds, they chase performance, and every time they do that, they incur costs, commissions, taxes, spreads, fees. All that activity adds up to dramatically lower returns over time. The investors who get rich are the ones who find a few good investments and hold them for decades. They're not doing anything. They're not being clever. They're just sitting there, letting compounding work its magic. Mistake number 6, not scrambling out of mistakes fast enough. Now, there is a part of life which is, how do you scramble out of your mistakes without them costing too much? This is a skill I had to develop the hard way. Early in my career, I made plenty of mistakes. I bought companies that didn't work out. I held on to losers too long. I missed warning signs that should have been obvious. The question wasn't whether I'd make mistakes. Everyone makes mistakes. The question was how much those mistakes would cost me. I learned to cut my losses. When a thesis broke, when the reason I bought a stock was no longer valid, I sold. I didn't hold on hoping it would come back. I didn't average down into a deteriorating situation. I admitted I was wrong and moved on. This is psychologically very difficult for most people. They don't want to admit they made a mistake. They don't want to take the loss. So they hold and hope. And often, that hope turns into much bigger losses. I also learned to handle losing hands well. Sometimes you find yourself invested in businesses that are declining. Maybe you bought them when they were good, but the world changed. Maybe you inherited a portfolio with problems. The question is, what do? You can't just hold on and watch them die. You have to be willing to take action. Sometimes that means selling at a loss. Sometimes that means redirecting capital to better opportunities. Sometimes it means completely changing your approach. The key is not letting your mistakes compound. One mistake is unfortunate. Doubling down on that mistake is catastrophic. Mistake number 7, choosing the wrong spouse. Let me shift gears here because life isn't just about money. We all know people who are outrageously well married. Their spouses are so much better than they are. Think what a good decision that was for them, and what a lucky decision. Way more important than money. A lot of them did it when they were young. They just stumbled into it. But you don't have to stumble into it. You can be very careful. A lot of people are wearing signs that say, danger, danger, do not touch. And people just charge right ahead anyway. That's a mistake. You can laugh, but it's still a horrible mistake. I've seen brilliant investors with terrible personal lives. All the money in the world doesn't compensate for coming home to misery. Your choice of spouse is probably the most important financial decision you'll ever make, even though most people don't think about it in financial terms. A good spouse supports your goals. A bad spouse undermines them. A good spouse helps you make better decisions. A bad spouse encourages your worst impulses. A good spouse is a partner in building a life. A bad spouse is an anchor dragging you down. I've been married for decades, and I can tell you, having a supportive partner made everything else easier. Making money is easier when you have a stable home life. Building wealth is easier when you're not fighting about spending. Achieving your goals is easier when someone believes in you. This isn't romantic advice. This is practical wisdom. Choose carefully. Don't rush. Pay attention to character, not just chemistry. And whatever you do, avoid people who show you early on that they're going to be a problem. Mistake number 8. Building monuments to yourself. Here's a funny observation about human nature. People build these enormous mausoleums. I think they figure they want people to walk by that mausoleum and say, "Gosh, I wish I were in there." It's absurd. Yet people spend enormous amounts of energy and money trying to impress others, trying to build monuments to themselves, trying to ensure they're remembered. I see this in business all the time. Executives who care more about their reputation than their results. Investors who want to be famous more than they want to be successful. People who spend more energy managing their image than managing their portfolio. It's all wasted energy. Nobody cares about your monuments. What matters is the life you actually lived, the people you actually helped, the work you actually did. Everything else is ego. I never cared about being famous. I didn't want to be on magazine covers or give speeches. I wanted to do good work for my shareholders. That was it. The recognition came later, and honestly, it's more burden than benefit. Focus on substance, not image. Focus on reality, not perception. Focus on what actually matters, not what looks impressive. That's how you build a life worth living. Mistake number 9. Not living simply and controlling costs. This business of controlling costs and living simply, that was the secret of how Warren and I built wealth. When we had tiny little bits of money, we always underspent our incomes. We invested the difference, and if you live long enough doing that, you end up rich. It's not very complicated, but people make it complicated. They think wealth means spending like you're wealthy. They upgrade their lifestyle every time they get a raise. They buy bigger houses, fancier cars, expensive clothes, and they wonder why they never get ahead. Living simply doesn't mean living poorly. It means not wasting money on things that don't add real value to your life. It means distinguishing between what you need and what you want. It means having the discipline to delay gratification so you can have real financial security later. I still live simply. I don't need a mansion or a yacht or a private jet. Those things don't make me happy. What makes me happy is financial security, freedom to do what I want, and the ability to be generous with people I care about. You don't need to spend a lot of money to achieve those things. The final lesson: you only need a few good decisions. Let me end with this. You don't need to make a lot of great decisions in life. You need to make a few good ones and avoid making terrible ones. That's it. That's the whole game. I made a few really good decisions. I chose to work hard and learn the investment business. I chose to focus on companies I could understand. I chose to be patient and let compounding work. I chose a good spouse who supported my goals. Those few decisions shaped everything else, and I avoided the big mistakes. I didn't overspend my income. I didn't let jealousy drive my decisions. I didn't pretend to know things I didn't know. I didn't try to do things that were too difficult. I didn't overtrade or make too many decisions. I cut my losses when I was wrong. That's all it took. Not genius, not luck, just a few good decisions and avoiding the catastrophic mistakes that destroy most people. You can do the same. You don't need to be the smartest person in the room. You don't need to find the next Apple or Amazon. You just need to avoid being stupid. And stupidity, fortunately, is avoidable if you're paying attention. So learn from Mozart. Learn from the young man asking how to write symphonies. Learn from my mistakes. And build a life that's based on substance, not image. On reality, not fantasy. On discipline, not impulse. Do that, and you'll end up wealthy and happy. Fail to do that, and all the talent and intelligence in the world won't save you. If these lessons resonated with you, subscribe now, like this video, and leave a comment. That simple action helps more people find this content and tells me that sharing these hard-earned lessons still matters.